Hey everybody, Chad Barnett with the Joey Cruz team here with Carrie Mason, tax professional, enrolled agent, to help you out with some of these questions that we need answers for that we get all the time. As an agent, people looking to sell their house are always worried about capital gains tax. That's come up frequently. Tell us, when does that come into play when you're selling a house?
Well, capital gains, simply defined, is the profit that you make on any capital asset that you own. A lot of homeowners, when they start to look to sell their house, they worry about what kind of profit they're going to have, because that's where that capital gains will come into play. However, there's a lot of scenarios to consider that, like, for instance, let's say Bob and Sally buy a home, it's $100,000 out the door, closing included in that. They live in it as their primary residence for 2 years. You have to live in it as your primary residence 2 out of 5 years to qualify for the exclusion. So they may not even have to pay capital gains. We just don't know until we look at all the individual pieces. But let's say that they buy a home for $100,000, then in that 2 years they put a new roof on it, they remodel the bathroom, they put $30,000 into it. So now when they go to sell it, and let's say they of course list it with the Joey Cruz team, and it immediately sells for $200,000. Well, their potential profit is $70,000. That is all that they would be looking to pay capital gains on if they even had to. But if you live in a home 2 out of 5 years, you qualify for an exclusion of up to $250,000 per individual. So if this is a married filing joint couple, they get $500,000. So that $70,000 never comes into play as far as being a taxable event for them.
We get this all the time though, because it's, we'll be at the closing table, they'll get a 1099 for whatever, and they may have lived in the house for 10 years.
Right.
At that point, that is really not an issue for them had they been in the house longer than 2 years, like you said, and the gains are not realized over $250,000.
Exactly. I have clients that will call me up and say, Carrie, I got this 1099-S in the mail. It came with my closing docs. What is this about? And all that is the attorney's office is doing their due diligence. This is a reportable event. So we take that form. We ask the questions like, when did you buy this home? How much did you pay for it? What improvements did you do over the years? What did you sell it for? What were the closing costs? That's something else that a lot of my clients tend to forget is what that commission that you pay, whatever, that all goes into money that you have put into this property. That is your basis in it. And we fill out the worksheet, we submit it to the IRS. It's simply for information.
Okay.
It just lets the IRS know this could be a taxable event, but now we've given you the detail to explain why it's not.
Let's take it another lane here. We have a set of siblings that maybe they inherit their mom or dad's house after they pass away, and the house is theirs. They go to sell it. Let's say they sell it for $300,000. What are they needing to be looking at in a situation like this, or maybe looking out for?
Well, step one, the biggest thing there is just what you said, that they inherit it. Because if you inherit your parents' property on the date of death, you get what's called stepped up basis, meaning let's say that your parents had $100,000 in it. But on the date of death, on that date or around that date, the siblings get an appraisal done, and that house is now worth $300,000. Their basis in it is $300,000. So if they sold it for $300,000, the gain is $0.
Okay.
So, but it's date of death.
Okay.
We have seen where parents will gift their home to their children before date of death, and if that's the case, the siblings' basis in it is whatever their parents' basis was in it. So we would revert back to that $100,000 that the parents had in it. They sell it for $300,000. They'll split that $200,000 in amongst the siblings, who will then take it to their individual tax preparers to work out the details of, am I going to be subject to capital gains? If so, what's my rate going to be?
Okay. Does, when you say that the capital gains is not an issue, should a married couple have a $500,000 gain? Right, it's $250 for an individual,
Mhm.
$500 for a
Right.
married couple. What if there are 4 siblings? Does it have to be $250 per person?
Well, that
Still,
goes
or
out.
is that different?
That goes out the window in that
Okay.
situation because
Okay.
this was not the sibling's primary residence.
Okay.
That $250,000 for an individual owner, or that $500,000 for a married filing joint couple ownership situation is only if it's been your primary residence for 2 out of the last 5 years.
Okay. And so, if you have been in the house more than the 2 out of 5 years, and your gains are not more than $250,000 individually, or 500 as a married couple, then you don't have to worry about the capital gains either.
Exactly.
Okay. So it's not all just doom and gloom when we're talking about capital gains. There are
Right.
ways to work around this. My advice as a real estate professional is to talk to a tax professional, somebody that knows what they're doing, somebody that has your best interest at heart whenever you have to worry about the IRS, because we don't want to be on their bad side.
Yeah.
It's not a good day.
Nobody
It's not a good day
does.
for anybody. Carrie, thank you so much.
Absolutely.
Appreciate it. So if this video helped you out, that's awesome. If you need more information or questions about what we talked about, let us know. We can put you in touch with Carrie. And if you need to sell a home and you're already okay with capital gains, we've already got all the answers here, give us a call today. Let us put your real estate needs in cruise control.